Okay, now there is one concept before we learn this financial instrument, we move forward. We need to understand a concept of amortized cost. What is amortized cost? You can consider it as book value. Book value, I mean the balance sheet value. The balance sheet value which we use, but it's a little bit different calculation. How to calculate this is what we need to learn here. Amortized cost. Let's suppose now we did our chapter provision, we did some other chapters as well. We understand that if we take a loan, for example, we issue bond. For example, we issue a bond for, say, I don't know, $100, or let me call it $100,000. So issue bonds, not bond, but bonds for $100,000. At 6%. At 6%. So a bond is a financial instrument. It's a debt instrument. It's a loan instrument. When you take loan, you make a loan note. You make a bond. Bond is bond, debentures. It's the same thing. It's a piece of paper. A bond looks like this. Let me show you like here. A bond will look like this. Usually the bond has a value of $100. The normal value is $100. So it's a $100 bond. It says that, at 6%, at 6% for 5 years. So the life is 5 years. Life is 5 years. And the interest rate, which is called the coupon rate. So 6% is your 6% coupon rate. Coupon rate means the interest rate. So we actually are looking for a loan. When we look for loan, we have two options. One option is that we can go to a bank and take a loan. Another option is that we issue these bonds. A bond is kind of a promise that if you give me $100 now, I will give you 6% per year for the next 5 years. And after 5 years, I will return you back your $100. So what will happen that we receive here $100, and in return, we will give $6, $6, $6, $6, and $6 here. And let me put them in minus because these are the negative cash flows. And then we will also have to give $100 back. So this is a situation of a bond. It's a debt instrument. It has a life of 5 years. It has a coupon rate 6%, which you can consider as interest rate. And you raise some finance through it. And actually, this bond, it becomes our liability because we receive cash. We have got debit cash here. We got here cash, $100. And then we have to return back something, credit. It's my liability here. Now, how much is liability? My liability is not 100. We have to calculate how much is liability here. So liability, I have to calculate. I cannot call it $100. What is my liability? My liability is this $6, this $6, $6, $6, $6, and $100. So I have to pay all of these, and we need to find out, we need to calculate their present values. We need to calculate their present values. So what we need to do, that we need to find out the present values of these future cash flows, like this $6. Actually, this $6 is here, but we need to see that how much of the $6 value we should be recording in today's term, because we don't owe $6 today. Today, we have to pay this $100 or we have to pay these $6 in different time periods. So what I need to do is that I need to discount them here, okay? This $6 will be discounted to this time period. And then this another $6, you need to discount this $6 also here. You need to discount this $6 also to the time zero. The time zero means today, because these are the amounts which I will pay in future, okay? I will pay these amounts in future. So I need to find out the present value of these things. How much is this $6, $6, $6, $6 in terms of today, and how much will be this $100 in terms of today. That is my liability, because liabilities we record in the present value terms. This is $100, but this is at the end of 5th year. This is 4th year, 3rd year, 2 year, and this is year 1. So how do I discount it now? Let's suppose they tell us here, the company has a discount rate of 8%. My discount rate is 8%. They will also say sometime here, effective interest rate. They will use that type of word also. So what we need to do, we need to find out the present value. As I told you before, that you should be watching that extra video from F9, which I will put in your syllabus on discounting and compounding. It's 20-minute video, which completely thoroughly explains the discounting compounding process. And if you watch that, I mean, it will clear out all your questions. But we know that the present value is equal to future value divided by 1 plus interest rate power n, where interest rate will be this 8%, n is the number of years. So if I make these cash flows, actually what will happen, you will have in year 1, 2, 3, 4, and 5. What you need to give? You need to give $6 in each year. And here you need to give $106. And you need to find out that $6 here. So this is my year. And here I put the amount. And here I put the DF. I call it DF. DF means discount factor. Discount factor means the present value factor. Now let me make you familiar with the present value factor or the discount factor. This $6, you must multiply it with the discount factor. What does that discount factor mean? Let me open up here. We'll go to Google and I'm going to show you some discount tables. Give me 1 minute and I'll open it up. Okay, so here we come on this table. We know that $1 today is not equal to $1 tomorrow. We learned this thing that money loses value with time. And discounting which we do, or discount factor which we calculate, we actually calculate the present value of the future cash flow. For example, if you have to receive $10,000 or $1,000 after 10 years, how much of that it is in terms of today? And how do you do that? You actually multiply your amount with the discount factor. So for example, in our case, what we are supposing, we say that our interest rate is 8%. And at 8%, we want to calculate in year 1. This is years. Number of years are shown here and percentage at the top. So if you see at 8%, the first year factor is 0.926. I'm sure that you people can look at it, 0.926. So that $6, which you will have to pay after 1 year, you multiply that $6 with 0.926. And the $6 which you have to pay in year 2, you multiply it with 0.857 and so on. And if you remember, in 5th year, you have to return back $106. And this $106, the discount factor would be in year 6. Let me draw a line so that it becomes clear. I just want to draw a line here. It is 0.681. So $106, which I will give in, 5th year, I would multiply that $106 with 0.681. So these are the discount factors, 0.926 and 0.857 for the year 1. Let's just remember these two things, 0.926 and 0.857. So it is 0.926 and it is 0.857. So when you multiply, here you call it DCF, discounted cash flow. And this is your, or you can call it your present value. So you multiply this with this. So it means that this $6, which you have to give after 1 year, the present value of that is only $5.55. And here, this dollar, it becomes $5.142. And similarly, you will find out the discount factors here and multiply it. Now, we can go back and take these values from the table, but we can calculate ourselves as well. Because we assume that it is 8%, I will do it with the formula because I know that it is 1 divided by 1 plus 8%, and I would say power 1 year, and it is with 8%, and I will just lock this cell so that I can copy paste my formula, and then I will drag it down. And if you see that this is 0.926 what we took and 0.857, these are the same numbers. And then I put it here as well. And I drag this one also. And now these are my present values. So what do they mean, the present values? It means that you actually have to pay, if it looks like that $6, $6 you have to pay. So these are $36, okay? And then you have to pay 100 further. So total you will pay 136, but the present value of that 136 is only 92, because this $6 is like, okay, this is actually, I need to show it in here so that you can say it is $5.6, $5.1, $4.8, and so on. So the total your liability, so your liability here is just 92. Now what is happening? You say debit cash, which is my 100, which I'm receiving, because when I issued the bond, I issued at $100. Or you can multiply it with thousands, whatever, and you will say credit liability, which is $92. And you can say credit equity, which is $8, because you need to balance, because you receive 100, but what you are going to pay is only 92. So 8 is equity. This goes to the shareholder benefit. This money is the, how to say, it is addition to the equity. It is addition to the shareholder wealth. I mean, when I issue the bond, listen, be careful. The other person is receiving 6%. He is getting 6%. What am I getting? Why should I give him 6%? I should also make some profit. He is earning 6%. What am I making now? We are making $8. And because I said that issue bonds for $100,000, each bond is 100. So it means that they probably issued, 1,000 bonds. So I can call it $100,000, and I can call it 92,000, and I will call it 8,000. So this is actually, I covered one topic. You call it, where you are splitting the equity and debt portion of a financial instrument. What I did in this process, I actually taught you something from financial instrument. We call it that splitting the equity and debt portion within a bond, or you can say that, compound financial, within a compound financial instrument. So this thing which we are seeing, it's a compound financial instrument. A compound financial instrument means which has a little bit of equity and a little bit of debt. So it has, or you can call it a lot of, a little bit of equity and a lot of debt. But the thing is that by making this transaction, we got some benefit. We got 8,000 in our equity. This is the money which belongs to the shareholders. And how did we do that? Very simple. We receive today cash. This is our asset. In return, we make a promise to pay $6 for the next 5 years and $100 at the end of the 6th year. And then what will happen? That you convert these cash flows, their present values, and the present values come out to be 92. So it means that all what you have to pay, the present value of the total cash outflow is only 92. So 8,000 is your own benefit. So we book it like this. Now, the problem comes now. Once I make it lie, now please, there comes a second issue, that how to book it, how to show it. Now in my balance sheet, my liability is shown as $92,000. I mean, when you will make your balance sheet, so let me show you how it would be reflected in the financial statement. In the financial statement, in your balance sheet, SOFP, what you have here, you've got assets on the one side and you've got equity and liabilities on the other hand. So you got cash as an asset, which is 100,000. And then equity. Equity is the money which belongs to the owners of the business. And liability is the money which belongs to the outsiders. So 8,000 you will write down in equity and 92,000 you write down in liabilities, and your two sides of the balance sheet are equal. That's how the balance sheet will be made equal. So I've got some liabilities, I've got some equity, and together they are equal to cash. So this is this double entry. This is how it will impact my balance sheet. Now the question comes here that if my liability is 92,000, if my liability is 92,000, how am I going to pay this $100 at the end of the 5th year? Because you got here only 92,000, but you have to pay 100,000. You can never pay more than your balance sheet liability. You will only pay the amount which is shown in the balance sheet. My balance sheet says I have a liability of $92,000, but after 5 years, I have to pay them $100,000. How would I do that? Now, for that purpose, you need to make amortized cost table. Here we start the topic, amortized cost table. What we have here, year 1, 2, 3, 4, and 5. And here you have your opening value. Then you will put your, coupon rate. Then you will say your effective interest rate. And in fact, let me change the places. It would be better if I put effective interest rate here and I put coupon rate here and I say my amortized cost. This is end of the year. So what will happen? Now, let me create some space. This effective interest rate is at 8%. And coupon rate was my 6%, which was 6% of principal, 6% of the actual amount. This is 8%, but I'm not saying principal or what. So in the beginning, I will book my, and let me call it open value and let me call it liability. So this is my opening liability. Opening liability, we know that it was 92,000. This is here. 92,000. Okay. When we started in year 1, we got 100,000, but we booked the liability as 92K. And our effective interest rate is 8%. It is 8%. So what will happen? I will say 92,000 multiplied by 8%, which is this much. So this is the interest which is adding up. But then I am paying interest. How much I'm paying? I'm paying 6,000 because I pay only on the bond, which is 100,000 into 6%. And this is I have paid. So this is my opening liability. This is the interest which has accrued. And this is the interest which I have paid. And when I make a total of that, I get a closing value of 93,360. Then in the beginning of second year, this becomes my opening value. And this time I should take this 8% of this one, the second year 8%. Now I will not take 92,000, but I will take 933 like this. But in this year, again, I will pay only 6,000. So this every year you will only pay 6,000. This amount is a fixed amount. You are not changing it. But this amount you are changing. Okay, let me make it like this. So the end of the year 2, what you have got is this amount in your hand, which is 94829. This becomes the opening balance for the third year. And then you calculate your 8% on this third year's opening value, and you get some number here. And when you fill in the numbers, I'll put it here. I take this one, and here I add my 8% into this one. And then I'll say this is from this one, and this is 8% into this one. If you pay attention, what we have done, we have got almost $100,000, 99,979. There is a little bit difference of discounting which we did here, because if you pay attention, this was also not 92. If I see here, these were, this is 92,000 something like this, because there were some discount factors. So this is a difference, very little difference, which is coming from rounding off, but effectively this is 100,000. This is how your 92,000 will become 100,000 in your books. But how do you make it in your balance sheet? Now, these values are called amortized cost. Okay, this value, when I say amortized cost, and I ask you, what is amortized cost? You will say, sir, amortized cost means the present value of the liability plus my effective interest rate, my cost of capital with which I did discounting, this is the effective interest rate, minus the principal, the coupon which I'm paying, minus the coupon, and the closing balance is called amortized cost. This is kind of a net book value of the asset. You know, like I told you that intangible asset, you calculate net book value. So this is kind of that thing. It's a book value of your liability. At the end of year one, liability is 93,360. End of year two, 94,829. End of year three, year four, and year five. The question is how to make the double entry. Now, if you remember, your first double entry was this one. This was your first double entry when you booked the liability. But what will happen that you would say that end of year one, you will make one more double entry. You will say debit finance cost. Debit finance cost. How much? This much. Debit finance cost this much. And I would say credit bond liability. And let me also call not liability, let me call it bond liability, okay? So I added up 7360 to the bond liability. So I already had a bond liability of 92,000. I had a bond liability of 92,000. Now let me make this one black so that we don't get confused. So this is my bond liability 92,000 already in my books. This is, you know, beginning of year one. And this is the end of year one. So beginning of year one, my liability was 92,000. Then I add this thing. This is my interest cost, which I calculated. So I call it finance cost. It is my interest expense. And I credit the bond liability because I have not paid it. But then I make a payment. Then I say debit bond liability. And I say credit cash or bank, whatever, with 6,000 because 6,000 I paid out. So I accrue my liability. How much? I accrue with 7,430, and then I pay. I minus. So here you make a debit to the liability. You are decreasing the liability. Here the liability increased. Liability 92 plus 7,360 minus 6,000. So when you will do like this, for example, I say, you know, 92,000 and I say plus 7,360 and minus 6,000 because I'm making a debit. So when you make a total, it gives you 93,360, the same 93,360. So this is end of the year two, end of the year one, my liability already has come 93,360. And then this transaction two, I will repeat it end of year two again, but with the different amounts. End of year two, I will again make here, sorry, what I did, I just need to take this one. This one I put here. Why it is taking 100,000? Okay, 7360. So this is year 2. But I will change the amount. In year 2, it is not 7360, it is 7469. It is increasing 7469, and it is 7469. But this will remain 6,000. So this is how you make your amortized cost. Amortized cost, if you understand, it is one of the key important areas of financial assets and financial liabilities, because we will show financial assets, financial liabilities based on amortized cost. I mean, it's one very important area of understanding your financial instruments. So what we learned now, we already have learned what is a financial asset, the definition we did, the types of financial assets we did. We talked about hedging. We talked about derivative. We talked about future forward option swap. And we discussed here, you know, splitting the equity and debt portion within a compound financial instrument, how to make it. And then we did amortized cost. So actually what was happening, that when you were doing discounting, you converted 100,000 into 92, because this 100 was there. And what you did with this 100, you brought it here to 92. You call it 92 here. And then through this process, you actually are now again making this, because I made it 92. So that was my discounting thing. And now I'm actually compounding. I'm doing unwinding so that it again becomes 100, and then I pay. So this process was essentially a discounting process. And this process essentially is a compounding process, because here I'm finding out the present value. And here I'm converting the present value into this value, 100,000. So you can consider this thing as a discounting thing, and this one as a compounding thing. And that's why I said that there is a video on discounting compounding which you must watch, and that will further explain you the process of discounting compounding. By the way, what you need in F7, I already have explained. Before, I thought that I would not explain this much. You will watch the video. But then when I started, I actually spoke many things. So I'm kind of satisfied that what you know now is enough. But if you further want to enhance your knowledge, you should watch that video also. So now we come back to our this PowerPoint thing, where we left it. We went to the Excel, and now we are coming back. So you already know that we discussed here a derivative. A derivative standing at a loss. Derivative we discussed, standing at a loss means that the market value was less, it was giving you loss. Or a derivative standing at gain. Then we talk about, it states that this is, forget about this thing, debt instruments. Debt instruments are those which meet the definition of a financial asset or a financial liability. Illustration, consider the following scenario: a company issues 100,000 6% redeemable preference shares. Now, I would stop the lesson today, because what I'm going to do next time, I will explain you the capital structure, the preference shares, the ordinary shares, redeemable, irredeemable, equity and debt. So that's a totally new topic, which we should be doing in our next lesson. So that is all for today. I would call it a day. I think we learned many things now.